Good afternoon and welcome back, everyone, to our week of navigating this volatility. We've This is our second special event we're hosting for the week. Yesterday, I hope many of you did join us on our session on just the general overview of how to navigate volatile markets, how to find opportunities in these types of markets, and the type of option strategies you can trade when things get extremely volatile, like we have seen over the last 4 or 5 trading sessions. But today, what we're going to do is we're going to talk about something more specific, which is trading 0 days to expiration options during this type of very volatile trade war that we find ourselves in the middle of. And I'll speak to why this is a strategy that's important, given the current market conditions that we are in. But you might find yourself um, uh, you might find yourself leaning towards these types of strategies when things are very volatile, when the market direction seems to change on a dime. Being able to trade kind of shorter time frame strategies, tends to lend itself well in these types of market conditions. So we'll kind of discuss the specific market conditions that um, make trading these types of products suitable, and then show you some of the indicators that you can use to try to gauge the actual directional view of the markets that you can use for these 0 days to expiration strategies. So just a reminder for those of you that are joining us for the first time here at OptionsPlay, we dedicate quite a bit of our time to helping you grow your trading account sustainably and confidently through these education sessions. The OptionsPlay education is here typically every single Thursday afternoon doing these sessions on different topics, trying to provide a well-rounded education for your investment portfolio, spanning technical analysis, fundamental analysis, option strategies, trading mindset, psychology, everything that we feel you need in order to grow as a trader. So if you're joining us for the first time, as you can see, there's a lot of people already in the chat window chiming in, saying hello and telling us where they're from. So if you're joining us for the first time, please chime into the chat window, tell us who you are, where you're joining from. As you can see, we have a very vibrant community of traders that are all here to support each other. But let's jump right into what we want to talk about here today. Before I do, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we'll be using during today's session. So we'll talk a little bit about the current market volatility and the current conditions that we find ourselves in, as well as implied correlations, which is, in my opinion, the more important indicator to pay attention to right now that tells us why we should be paying attention to 0 days to expiration strategies. And then we'll talk a little bit about the different products that you can trade for these types of strategies. We'll talk about the trading strategy and the market internal indicators that are useful to gauge the directional view, and then we'll open this up for Q&A here at the very end. But the primary question that I want you to be able to walk away from here is to just understand, the foundational knowledge that's required to trade 0 days to expirations during, these times of excess market volatility. So we'll kind of talk a little bit about how markets are different during times of market stress that provide more opportunities for trading 0 days to expiration options, and then how can you determine intraday market direction for trading 0 days to expiration options. So we'll cover all of that here during today's session. Now, many of you will ask, are asking, are these sessions recorded? And the answer is absolutely yes. If you have a free trial or a membership here at OptionsPlay, you'll get access to not only the recording and the slides for today so that you can watch at your own pace and follow along, but you'll also have access to the tools to be able to structure the 0 days to expiration strategies that we'll go over during today's session. And I'll also have at the very end for you some of the links to a dashboard that I created that has all the indicators that I'm going to go over today so that you don't have to figure out how to compile these things on your own. You'll be able to use the dashboard that we've created to be able to track the directional view of the market from an intraday basis. And also for any of you that are subscribed, you would have received an email like we sent out here this morning that gave you an actual signal based on the indicators that we're going to go over today. So we started sending this out earlier this week during market volatility because we recognize that a lot of people intraday are trying to figure out are markets heading lower or heading higher, and we wanted to publish the indicators that we are going to walk you through today to show you kind of how we're using these indicators and what those indicators are telling us in terms of market direction. So this was the alert that we would just sent out here at 10 a.m. today. It was a very neutral alert in terms of what the market internals are showing us. And so far, we've got a pretty flat day here. So I'll be walking you through these indicators, but if you want this daily email from us, on what the indicators are telling us, just simply have either a free trial or a membership, and that will get you access to that daily intraday signal that we will be sending out going forward. So the first thing I want to talk about is implied correlations, because the one thing that has really changed in the last, I'll call it 5 trading days, is really the significant change that we've seen in implied correlations. Now, implied correlations tells us how correlated are stocks. Specifically, this is the CBOE implied correlation index. So it's based on the S&P 500 stocks. And what it's telling us is how correlated are the 500 stocks to each other. When correlation is low, like it was a month ago, that's a really good market opportunity for picking stocks, meaning some stocks are moving higher, some stocks are moving lower. There's a lot of dispersion. There's a lot of opportunity in single stock. When implied correlation is high, that means all stocks tend to be moving in tandem with each other. So there's a higher probability or higher correlation of, all stocks moving higher or all stocks moving lower, like we've seen here over the last few days. And when implied correlation is high, like it has spiked here, and as you can see, this is a chart going back over 12 years. As you can see, we're sort of near the higher end of the curve with regards to where implied correlations are. And what that's telling us is that a lot of stocks are moving in conjunction with each other, meaning these are not particularly great times to be a stock picker, that these are better times to be a market direction navigator, if that makes sense. Meaning, if all stocks tend to move higher at the same time and all stocks tend to move lower at the same time, you're better off trading a basket of stocks like an ETF rather than trading single stock, because you don't particularly get any alpha by picking individual stocks. Okay, does that make sense, everyone? So because implied correlations are very high right now, it is better to be trading trading an index through an ETF rather than picking individual stocks. And with the VIX basically closing at a 5-year high at 52% yesterday, or I'm sorry, this was from today, volatility is extreme, meaning you're going to have pretty extreme days from a directional perspective on these indices. So you could have a day where and we've seen it over the last few trading sessions, where you could have wild swings where the market is up 4 or 5% in the morning and down 4 or 5% in the afternoon. And then by the close, you're flat on the day. So we're talking about very, very strong moves, and they tend to move very, very quickly, or rather they turn very, very quickly. So what that means is that in the short run, our expectations are very fast, violent moves that can change direction very quickly on a daily basis. So that's really the basis for why trading shorter dated options on the indices is the strategy that can provide alpha in this type of market environment. You know, you could be a long-term investor and sort of ignore this sort of volatility and know that it will die down eventually, and there's nothing wrong with that. And then, but for those of you that like to take advantage of the volatility and take advantage of um the big moves that we've seen so far, the way to do that is to use shorter dated options, but do it in a way where you have a directional view on the markets. And that's what we want to lay out here during today's session. So let's talk a little bit about ETF versus index options. So, when we talk about 0 days to expirations, you have uh, two different choices. You can trade them on ETFs or you can trade them on index options. And the real difference between them is really physical delivery versus cash settled. Because ETF and equity options are both physical delivery, meaning if you are assigned or if you choose to exercise a call or a put option, it results in you either owning or being short 100 shares of the underlying security at expiration. Index options are cash settled, meaning there's no delivery because you can't take delivery of an index. It's just whatever the P&L of the trade is settled in cash in your portfolio. So, generally speaking, ETF and equity, rather, let's just talk ETF options because, we're talking about in the context of 0 days to expiration. They tend to be better suited for smaller accounts based on the size, right? SPY is a $500 stock or $500 ETF versus SPX, which is the index option on the S&P 500, is a $5,000 notional. So you're talking about a size that's 10 times larger. We talked about physical delivery, so there's exercise and assignment risk with ETF options that you don't have when you're trading index options. That I would say is definitely one of the key benefits of index options is that you don't have to worry about exercise and assignment risk. You can just hold strategies like a 0 days expiration to expiration and know that whatever P&L that you get on the trade is debited or credited into your account. You don't have to worry about, am I going to be long 100 shares the next day or short 100 shares, or have to close out a trade before the close to avoid that expiration risk. ETF options are relatively easy to track because they're all PM settled, meaning they settle based on the 4 p.m. closing price of the day, versus index options have a combination of AM and PM settled. PM settles are pretty easy. AM settles are a lot more trickier because they basically cease trading the day before and are settled based on the opening price the next day, which is really confusing because you have overnight risk, but you can't do anything with the position overnight. And then ETF options are taxed as ordinary income versus index options have a tax benefit. They're taxed at 60% long-term, 40% short-term. So if you're trading these in a taxable account, the index option theoretically has an edge from a tax advantage perspective. So one is not better than the other. It's just a matter of understanding the right product for you. And a lot of it, from my perspective, comes down to size. How big is your portfolio and whether or not you can trade SPX versus SPY. But from a trading perspective, they're very similar to each other. Now, when we talk about trading 0 days to expiration, it's incredibly important to actually understand the statistics of market movements because most days lack what we call strong direction. So only, when we look at the statistics, only about 15 to 20% of any given day have what we call a strong trend. So meaning only about 15 to 20% of the time will you consider trading 0 days to expiration strategies for a directional perspective. And then most of the days are suited for selling options, meaning selling premium, selling credit spreads, selling iron condors, selling straddles and strangles, basically collecting income. And then in the 10 to 15% of days when the market tends to have a strong trend, that is when you can really hit some home runs using shorter dated expiration strategies. Now, the difference between sort of when normal market conditions versus the markets that we're in right now is that you tend to get far more days of strong directional moves in this type of market environment than you typically do when things are more normal. So, but what that translates to is just that you have more opportunities to hit really big home runs trading 0 days to expiration options now than you do during normal conditions. But in order to kind of hit those home runs, what you really have to do is have a method to determine who's in control, buyers or sellers. And this uses a combination of price action alongside breadth indicators to provide what we call a complete picture. This requires intraday indicators, meaning, if you have a charting package where you're set up with daily charts or weekly charts, that's just not going to give you the granularity of information that you're going to need to gain that directional knowledge. But today what we're going to do is we're going to show you 4 intraday breadth indicators that's going to give you a better understanding of who's in control and whether or not you're going to have a strong trending day, which are the days that you can potentially hit those big home runs that I'm talking about, trading 0 days to expiration options. Okay, so let's discuss kind of what those 4 indicators are. The first one is volume profile. And volume profile is a unique way of looking at volume because traditionally most charts have volume on the time axis, right? So you can see, okay, at any given time, how much volume was traded. But time is sort of an arbitrary um, framework, right? Who cares if it's just every 5 minutes or every 10 minutes or every hour in terms of how much traded? What volume profile does is it plots the volume not based on time, but based on price, meaning how much volume was traded at each given price. And what that gives you a better information on is really just how is the distribution of buyers and sellers, or how is the distribution of price on a given day? Meaning, when you get a day that where the volume profile is sort of bell curve shaped, what that means is that there's more of an equilibrium between buyers and sellers. As price kind of gets higher, it kind of gets knocked down. When price gets down, it kind of gets brought back up. And what you end up doing is you get a bell curve with kind of a point of control, or this red line, which is where the most amount of volume is traded, kind of around that bell curve. And what that again tells us is that volume is distributed fairly equally throughout the day, meaning neither buyers or sellers have control of the markets. On the flip side, if you have volume profiles that are relatively flat, right? So you start a day and you start to just start to trade higher, and as you can see, the volume profile is very much flat. What that kind of generally tells you is that one side of the market is having control and it's just pushing the markets in one particular direction. And it's pretty easy visually to see which direction that's going in if you're using something like a candlestick chart. But the volume profile basically just helps you validate that one side of the market has control of the market. So what you're basically looking at is just the shape of the curve, right? Do you have more of a bell curve for the day, which is telling you that you have a more neutral, a more equilibrium between buyers and sellers, or do you have a flat profile, which is showing you that it's more likely that one side of the market has control of the markets? So just to kind of show you this morning, the signal that we sent out this morning, SPO, we were trading basically at the what we call the point of control, or the significant volume node, and which was at $500 with a curve profile shape. That's what we were seeing at about 10 a.m. this morning, and that's what we sent out, suggesting a more short-term outlook on the S&P 500. Okay, so what I'll do is I'll kind of go through each one and I'll show you kind of what it looked like this morning. Okay, and this morning at the time at 10 a.m. we were basically seeing a pretty bell-shaped curve profile with kind of this price trading just around that point of control, which is where most of the volume was traded. And that means that we don't really have buyers in control or sellers in control. There's a good amount of equilibrium between the two. Does that make sense, everyone? Please type one into the chat window if that makes sense to you. Perfect. Okay. So number one is always price action. Price action is by far the most important tool that you have in your toolbox to gauge who has control and whether or not today is perhaps a better day to be a seller of premium, or today's a better day to be a buyer of premium. And like I said, 80% of the days you're going to likely be selling. But in those 10 to 15, 20% of the days when things really take off, that's when you want to be able to identify those days and be able to hit home runs. Okay. But today is a day where, buyers or sellers, none of them really have control of it. Maybe in the afternoon that will change, but as of right now, that isn't the case. You're better off potentially being a seller of premium on a day like today. At least that's what the volume profile is telling us. We're going to look at 4 different indicators, and we're look at them in conjunction with each other to get a better sense for if one strategy makes more sense on any given day. Okay. The next one we're going to look at is cumulative tick. And what that is really doing is it's a very high frequency indicator. What cumulative tick is telling us is the number of stocks that are ticking higher on any given moment versus minus the number of stocks that are ticking lower. So it's literally every single tick. It's not over the last day. If you look at advanced decline, that's telling you over the single day how many stocks are advancing versus how many stocks are moving lower. And that's basically looking at like how many stocks are positive versus how many stocks are negative in terms of performance on the day. But this is just looking at like what's the most recent tick, right? Meaning if Apple went from $120 to $121.01, that would be a positive tick. And if it went down from $120 down to $119.99, that's a negative tick. It's a very, very high frequency data point that's extremely noisy. If you look at a chart here, this is what cumulative tick looks like. It's an extremely noisy indicator, and it tends to go somewhere between, negative 1,000 to positive 1,000, because generally speaking, you don't have too many instances where there are more than 1,000 stocks that are ticking higher than ticking lower, because we're basically subtracting the number of stocks that are ticking higher from the stocks that are ticking lower. So the equilibrium tends to be around the 0 line. And then, you get extremes on either end, at 1,000 or a negative 1,000 if you have a relatively strong down days. But because tick is just too noisy of an indicator, what is better to look at is what we look at cumulative tick. What we do is we continue to add up, the number of ticks throughout the day. And what you generally want to see, and that's the indicator here at the bottom, right? Instead of looking at the ticks on a tick by tick level, what we look at is we basically start adding it up throughout the day, right? And so if you look at kind of this price chart, each of these is one trading session, right? So this is one trading session, that's another trading session, that's one day, right? So and if you look at kind of each individual trading session, you'll see, on this trading session, cumulative tick just kept moving lower and lower and lower. This moved lower and then kind of starts to retrace. This largely kept growing throughout the day. This largely kept growing throughout the day. This was kind of more of a flat day. This was a bit of a flat day. This started to move lower. This was a strong down day, flat, flat, and then a little bit higher towards the end of the day. But basically what you're trying to see is, are there days where there's a continuous bars of either increasing or decreasing without a real break in that trend. And what that is telling you is that whether, one side of the market has control over the other, right? When you do have days where there is a continuous bars of increasing or decreasing without really a lack of break in the trend, that's showing you one side has control. But if you find bars are oscillating between higher or lower, that's telling you that there's more equilibrium and it's better to be a seller of options. So if you look at kind of the cumulative tick as of this morning, right? And just to actually, you know what? Let me just show you the actual dashboard as opposed to showing you the email. Give me 1 second to bring that up. If you look at cumulative tick from this morning, at 10 a.m., so just to kind of give you context, this was cumulative yesterday. Basically, from the beginning, we started to turn negative, and it just basically kept going negative and growing and growing and growing until the close. And if you look at yesterday's price action in terms of the market, right? What was interesting yesterday, I think, actually, I take that back. This is the full session. Yesterday, cumulative started off pretty strong. We just kept getting bigger and bigger green bars, but that quickly turned at around 10:30, 11 when things started to turn around. And throughout the rest of the day, starting at around noon, we basically got continuous red bars, red bars, red bars, red bars. And basically starting at noon, that's when things really started to take off and we had a big strong down day yesterday, right? So, that's really where cumulative tick can help you confirm that even though buyers had control in the first 30 minutes or so, sellers started stepping in around 10:30 and just maintain control throughout the rest of the day, right? So looking at kind of where cumulative tick is for today, at the very beginning, it was very flat. We really didn't get much, right? It's starting to increase a little bit more here to the downside. It's not particularly strong here. And then also when you look at volume profile here, a very, very bell curve shaped profile today. So when I look at that bell shaped curve and I see cumulative tick kind of moving a little bit further south, it's not a particularly strong signal because because the volume profile is very bell curved and we're just trading around kind of an equilibrium. So no sellers or buyers really have control over the markets here right now. So, cumulative tick doesn't mean so much here unless things really start to take off here and we start to break below, the trading range. So right now we're trading between 493 and 503, right? If it breaks below 493 and cumulative continues to move lower, that would be a pretty good indication that sellers have started to gain control of the markets. But as of right now, no one really has control at the moment. Okay, does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Perfect. Okay, so the next one we take a look at is advanced decline. Just simply the number of advancing stocks minus the number of declining stocks on the New York Stock Exchange. You can do it on the S&P 500, you can do it on total market, but the New York Stock Exchange is comprehensive enough where it gives you a very good reading. And we generally use this in conjunction with volume and price action. Basically, readings that open and remain above 1,000 all day or open below negative 1,000 all day show control or some type of strong shift from positive to negative, which is generally speaking the right opportunity to be buying options. Readings that sort of oscillate between negative 100 and positive 100 show lack of control by either side and is generally a better suited for selling options. So let's take a look at where we are today. So today we opened up here basically at negative 1,500, right? So kind of very much on the negative side, but very quickly, before 10 a.m., we made it all the way to zero. And that basically meant that, at the open, there were a lot of stocks that were there were far more stocks that were in the red versus stocks that were positive. But by 10 a.m., we were basically flat, meaning the number of stocks that were positive versus the number of stocks that were negative we're largely in equilibrium. We have traded all the way down to about 1500, but we're back up to 800. So, it's oscillating. It's not really showing us any strong movement versus if you look at kind of yesterday was also an interesting day because we opened up at positive 2200. So a very strong open, but it basically couldn't sustain it and it kept dropping from there, right? So it went from 2200 down to 1200, went back up to 1500 and then dropped to zero very quickly. So, by the time, when we were starting to break below, some of the support levels here around 515, we were already starting to go much, much more lower, right? So this is a pretty significant change to go from 2200 down to 900, down to zero, and then eventually turning quite negative here by the close. By the close, we were basically down at around negative 1300, right? So that's a very big swing intraday from up 2200 to down 1300. So that's kind of what drove kind of the sell-off here yesterday, and we can confirm that in the advanced decline line intraday yesterday. So, this is really something that is important to pay attention to. And as of right now, like I said, we kind of got very much an equilibrium somewhere between negative 1000 and positive 1000. Really means that there, especially when you kind of oscillate between these two levels, that's really showing us that no one really has control, at least for today, right? So, for example, if you look at the email that we sent out here this morning, right? Basically, we said cumulative was at negative 327, which was not particularly negative. Advanced decline was at negative 1290. So a slight bearish bias on both cumulative and advanced decline, but not enough to necessarily push this into a bearish view, especially when the volume profile had that bell curve shape and we were trading just around that, what we call point of control. Okay. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. Perfect. Okay. And then the last indicator we look at is volume ratio. So, before we're looking at the ratio of stocks that are, or rather we took advanced decline, which is the number of advancing stocks minus the number of declining stocks. The volume ratio is looking at the volume of stocks advancing versus the volume of stocks declining, right? So if you have 10 stocks that are advancing and 2 stocks that are declining, then you have a volume ratio of 10 to 2, right? So what we're looking at is kind of the volume, meaning how much volume is there from buyers and how much volume is there from sellers. Now, because this is a ratio, it works a little differently. What you're doing is you're looking for readings that stay consistent or increasing for at least the first hours of trading day or into the close. We tend to get these big moves into the close a lot of times, right? Especially when things are very volatile, you get these big swings into the close like we did yesterday. And what you're looking for, because it's a ratio, generally you want to look at bullish side, we're looking for our readings above 3. Above 3 is showing you kind of, buyers have control. Below 0.33 is showing you that sellers have control. And in both of those instances, those are potential opportunities to be long options. Otherwise, if you're somewhere between 0.5 and 2, that's showing you there's really not a strong side in terms of volume, and you're probably better off selling options. So, for example, this morning, we found ourselves where the volume ratio is basically at 1, right? So right now it's at 0.7. But when we sent out the email around 10 a.m., it was basically just around 1, meaning there really was no significant volume on ups or downs. They were very well balanced, which is why we sent out our email this morning saying that there's a good balance between buying pressure. So we have a more of a neutral sentiment because the current reading at the time was 1.05. So when we look at all of these things in conjunction with each other, that's when we can get a more complete picture especially at around 10 a.m., which is many times when you might want to establish your first position for the day if you're doing 0 days to expiration, right? And then, at noon is usually when you tend to reevaluate that. A lot of times, a lot of trades for 0 days to expirations tend to get closed around noon, especially if you're trading, selling option strategies. You might open at 10 a.m., close by noon. So, for example, at 10 a.m., if you were to sell a credit spread or a straddle or a strangle, by around, by the time we opened this webinar about half an hour ago, a lot of times you might have the opportunity to close that trade already at that time. Now, given the current market volatility that we've seen, we never know what could spark a strong rally here today, or spark another big sell-off here by the end of the day, right? And that's kind of what makes the current market conditions unique, because during normal market conditions, we don't get these types of opportunities as often, and we certainly don't get such big moves, all the time, right? So what we really find is and let's just look at kind of where the markets were the last few days, right? So let's start with this was the third. That was the first big day of that sell-off, right? So, when we opened, basically we opened and by 10 a.m., I would say, we had a pretty flat profile. The profile here looks a little bit bell curvy at the time, but that's because, that's for the full day. But, if you, by 10 a.m., you basically opened up at around 5:47, and by 10 a.m., we were already trading at 5:42 here to the downside. So, a pretty flat profile by then. Look at the advanced decline. We went from negative 1,700 down to negative 2,000. So meaning telling us sellers clearly had a lot of control. Look at the number of bars here. It was just red, 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 kept decreasing. Volume profile, the number of up volume versus down volume, 0.17. What that 0.17 means that there were 8 times more down volume than up volume, right? So basically everything was showing us that this was going to be a pretty ugly day, and it stayed ugly throughout pretty much the entire day, right? It did get a little bit better kind of towards noon, but then as it got into the close, it just kept deteriorating across the board on all of the indicators, on advanced decline, on volume, and the profile, just kept moving lower, and basically ended the day at 537. The next day, same thing, right? We opened up at 532, traded down to 517 by 10 a.m. And then if you look at kind of where did we open up? We opened up at negative 1900, and by 10 a.m. we're already down to negative 2400. And again, cumulative tick kept moving lower and lower and lower. We opened up down volume at 0.06. That's telling us that, down volume outpaced up volume by more than 12, 13 times. So, very negative day, and we kind of just continue to stay negative throughout the day. Basically cumulative never got better. Advanced decline really didn't get better. Up down volume didn't get better. And basically, at 10 a.m. we were at where were we at? At 521, and at the close we were down to 505, right? The next day was interesting because I think this was Monday the 7th, right? And this is when we sent out the first trading signal, because at 10 a.m. things looked pretty bad at the time, right? 10 a.m. the profile was sort of bell curvy at the time, but as you can see, we opened up at 10 a.m. Advanced decline was negative 2,300. Cumulative tick wasn't particularly strong on that day, but up down volume, as you can see, at 10 a.m. we were at 0.15, meaning down volume outpaced up volume by about 8 times, right? So across the board, things were still looking pretty negative. But things really kind of turned back a little bit throughout the day. As you can see, we started to get a much more bell curve shaped profile throughout the day. Up down volume spiked all the way up to 5 times, meaning up volume outperformed down volume by 5x. Advanced decline got positive to 700, which is a pretty wild swing from, being down 2,600 all the way back up to 700. That was the crazy day, right? Where the S&P traded all the way up to 523 and then closed the day back down at 504, even though, we opened up at 480 something, right? So this is one of the biggest swings we've ever seen in the S&P 500 on an intraday, certainly within like a 30-minute period, going from 482 up to 522 and then back down to 502. That was a really wild day. And then yesterday, like I said, opened up, looking like pretty strong, and then by noon things really started to deteriorate. So things change a lot, but these are the indicators that can help you confirm what's currently going on. Meaning the profile, the price action and the profile is always going to be your most important indicator to gauge that, and everything else will help you validate, what's moving and who has control. It's really a powerful set of tools that intraday traders use to gauge market direction that you can use for trading 0 days to expiration strategies. So let's just take a look at kind of, looking at the markets today, right? We're at a very flat day. We're trading, the point of control of the S&P 500 is at 500. We're just trading at 500, a perfect day for potentially selling perhaps a straddle. Looking at something like selling like a $500 straddle or maybe $499 would be an ideal straddle to trade, or maybe a strangle for those of you that maybe don't want to sell a straddle. Or you can potentially, take a credit spread as well, right? So you can sell, a slightly bullish or slightly bearish credit spread as well. I'm using SPY here, using the April 9th expiration, which are the strikes that expire today. But you can use OptionsPlay to basically analyze the trades and basically say what happens at expiration. If everything stays the same, what is my potential profit? What is my potential risk if this thing goes substantially higher, substantially lower, so that you can get a sense for that. Even if the stock trades even if it trades, outside of this range to five, let's say 505, how much do I have to risk? This is really what you can do, the type of analysis you can do with OptionsPlay and get a sense for that before you click on trade. And you can always paper trade this. That's one of the powerful tools that we offer here is you can create a new portfolio, such as create a paper trading portfolio. You can click on add position. And then now you can start tracking these positions in your paper trading portfolio and see how they perform and trade these for maybe a few days before you are comfortable enough to start trading this in your real account, right? So here I've sold the April 9th 499 straddle, and I can see kind of how this performs throughout the day. And I can come back here later today and see how it's doing, and make decisions as to whether or not I want to close it or adjust it. And once you feel comfortable enough, you can actually start trading these strategies in your portfolio. Now, I saw a few questions about these specific indicators. So what we have built is a dashboard on TradingView. Now, this does require a paid account with TradingView in order to use it. Not because the indicators are special or there's anything about it that requires you to have a paid account, but TradingView doesn't allow you to view 4 charts on one screen unless you have a paid account. You can always do it one by one if you want, if you don't want to pay for the account. And the other thing about the paid account is it allows you to do custom indicators like I have with Cumulative Tick, right? Otherwise, you just have to look at Tick yourself and kind of eyeball it. Is it mostly staying negative? Is it mostly staying positive? You can eyeball it, but the Cumulative Tick makes it just easier to visualize and see kind of, okay, it clearly is continuing to trend lower here versus, here you'd have to kind of see where the zero line is and notice that it's mostly trading below the zero line. So it's moving lower here. And volume profile is also what do you call it? An advanced indicator that you only get with a paid account. But if you do want to take a look at this dashboard, you can just click on the link that I posted in the chat window, or scan your phone to that QR code. That will take you to a TradingView page that I've already built that has this exact dashboard. Otherwise, if you're a subscriber to OptionsPlay, like I said, we send you these daily trading signals, which basically gives you the dashboard and interprets it for you and gives you what the current market favors for the day in terms of a directional view for trading your 0 days to expiration options. This gets sent out at 10 a.m. so that you can basically take that information, plug it into your trade. So for example, at 10 a.m., what you could have done was go ahead and sell that $500 SPY put. I'm sorry, SPY straddle or strangle or iron condor, given the more neutral nature that we find ourselves in. And by the start of this webinar at 12 o'clock, you could have been out of that trade with this trading signal. So it's definitely something that's not for everyone, but a lot of you have expressed interest in trading these types of products. A lot of you have traded these products, and a lot of you have asked us, how do you actually determine, what to trade from a 0 days to expiration perspective? And what we wanted to do is basically show you a template for what to look for, how to interpret it, and then what you can do to actually trade these specific strategies. I saw a couple of people asking about doing this in Thinkorswim. You can do most of this in Thinkorswim. You can do the volume profile with a 5-minute chart on SPY. You can look at tick. I haven't figured out how to do the cumulative tick in Thinkorswim. Advanced decline line you absolutely can do. An up down volume ratio is probably the one that you have to figure out. You might have to look at it and maybe do some math, meaning you might have to chart these two indicators separately. Or actually, I think the up-down volume is the one indicator that's not available on Thinkorswim. I think cumulative you can do, and you just have to write a custom formula to do the cumulative part of it. The advanced decline line, I know Thinkorswim can do, but I think the up-down volume was the one thing that I couldn't do in Thinkorswim, because I know I tried to do this about a year ago, and I know that I couldn't do it. And there was just one indicator that I couldn't do, and I think that was the up-down volume ratio. But you can get pretty close in Thinkorswim. For free, which is obviously a huge benefit for those of you that do have Thinkorswim. But if you're interested in Thinkorswim, we're going to be doing more Thinkorswim tutorials coming up, specifically around trading options, scanning for opportunities on Thinkorswim. So if you're interested in that, please let us know, and we'll prioritize those Thinkorswim tutorials since a lot of you like using it, and especially with AI now. All of the think scripts that you can write, kind of custom formulas, custom indicators, custom scanning tools. Now that you can use AI to kind of build to help you write code, Thinkorswim is a very powerful platform for a lot of people, even if you have no coding experience, to be able to build a really powerful, custom version of Thinkorswim tailored to your specific needs. Okay. That covers what I wanted to share with you here today. Just a reminder, if you want access to the daily 0 days to expiration signals email that we send out, those go out to all of our free trial and members. You can sign up for your free trial at optionsplay.com/signup. Or point your phone to that QR code on your screen. Philip was kind enough to drop that link into the chat window for those of you that are on a computer and you just want to click on a link. It takes 10 seconds to sign up. It'll give you access to the OptionsPlay platform that you can use to structure those 0 days to expiration option strategies. It'll give you access to today's recording and slides so you can follow along at your own pace. And it will give you access to the daily newsletter that we send out at 10 a.m. with today's 0 days to expiration signal based on these 4 indicators that I just taught you during today's session. With that, let's turn over to the Q&A section. There's a Q&A button at the bottom of your screen. If you don't mind, type your questions into the Q&A window, and I'll try to answer as many questions as I have time for here today. How does one view implied correlations on OptionsPlay or another source? The CBOE is who publishes the implied correlation index. So you can just Google implied correlation index and you can find it on the CBOE website. 0 days to expiration SPY calls can't get exercised in after hours trading. Exercise you can do until around 5:30 p.m. Eastern time. So, theoretically, your call option could expire out of the money at 4 p.m. But after hours, the stock moves, and someone on the other side of who owned a call or a put could choose to exercise all the way through 5:30. So there is still exercise risk all the way through 5:30, and as the seller of the option, if your calls were exercised, you don't actually know until the following morning. Which is why, generally speaking, you do want to close those, especially if you're finding yourself that you're kind of close to the price of the stock, meaning the strike price is close to the current price of the stock. You never know what happens after hours that might drive someone on the other side of the trade to exercise their call or put. So to avoid that risk, you generally want to close these trades prior to expiration. In this market, is it more advantageous to buy puts or sell call spreads? That's a good question. You have to take it on a day-by-day basis, right? Market direction changes so frequently, it's really hard to say that. Statistically speaking, selling puts has a higher probability of success, but during market crashes, selling call spreads will likely be more profitable. But that's purely from a directional perspective, right? That's why I'm laying out the tools that you need to kind of make a better call on market direction so that you can make the decision as to whether you want to sell calls or sell puts on the day. How do I avoid pattern day trading with 0 days to expiration? You can't really. You can do it if you're trading um, um, options on futures, or you can do it by just holding it to expiration and not closing out the trade. But if you're going to open and close intraday, that's going to be count towards your day trades. Confused about cumulative tick, red versus green. Is correct to say increasing red equates to increasing moves to the negative and increasing green equates to increasing moves to the positive? Yes, that's exactly right, Chris. The question was on cumulative tick and what that means. Basically, if there are more stocks ticking higher versus lower and it continues to do that, then you start to get increasing greens. If you get more ticks lower, meaning if it keeps getting more and more negative, then you get increasing red bars. Ignoring hindsight, how should today have been played? I think, we sent out this newsletter at 10 a.m. saying take a neutral view from a 0 days to expiration perspective. So that would have been selling straddles, strangles, iron condors. You could have sold credit spreads if you, kind of had a slight directional view, or if you just, sold the credit spread that's relatively far out of the money. But, that's what you would have done at 10 a.m. and you would have been out like around 12:30 by the time we had started this webinar. For all the questions that I've seen on how do you kind of get access to the indicators that I'm showing you, again, you can access it using that code on your screen, or I'll post that link here again in the chat window. But just to remind you, if you want to replicate my dashboard and TradingView for yourself, you just need to have a paid account in TradingView in order to do that. Where do I get this link again? I just posted the link again in that chat window. Volume up versus volume down means the number of it's not the number of stocks. Um, it's the actual volume of up down that it's calculated. That's exactly right. It's not just the number of stocks, it's the volume that's traded. If you want the four charts like I have here, you just have to click on the link. That will get you access to that. Can you do this in stock charts? Great question. Now, the thing that stock charts doesn't offer are custom built indicators, and some of these are based on custom built indicators. So I don't think you'll be able to replicate this in stock charts. Even though stock charts has things like advanced decline, and it has tick, it has all of these things. But there are just a few kind of custom things that I don't think you'll be able to do in stock charts. But I will take a look at that. If you want, send me an email at info@optionsplay.com. We'll look into that and get back to you. Does price generally retrace to the red line on a volume profile chart? When the volume profile has an equilibrium, like I'm sorry, has a bell curve like it does today, then you tend to have a much higher probability that it just trades around this red line, which is the point of control. Um, yeah, so it's a much higher probability today that we'll just end up trading on closing somewhere around $500. What are the best deltas and expiration dates for protective puts on any sell strategy? I'm not sure what you mean by a protective put on a sell strategy. If you don't mind clarifying, I'm happy to try to answer that question. Any trading rules on 0 days to expiration trades? So I actually have quite a few videos on our YouTube channel specifically to that. I also hosted a really great session with Tom Sosnoff in January on that. Um, Let me see if I can get that link. Hey Philip, if you don't mind, do you mind taking a look at our YouTube channel and finding the link on that video I hosted with Tom on January on 0 days to expiration? I think it was on January. Um, Oh, sorry, it was December 2024. Actually, you know what? I just got the link here. I'll share the link with everyone. If you want more rules on trading 0 days to expiration options, I hosted a really fantastic webinar on this topic with Tom Sosnoff back in December of last year, where we went over basically all the rules for trading 0 days to expiration. That was a really fantastic session. So please go and take a look at that session because I think that really includes all of the rules that I would try to rattle off right now. If you have an OptionsPlay account, we will send you an email once the recording is up with the slides. Is there a way to automate trading based on these indicators? You know, we live in the day and age of AI, where if you can write something out in plain English, AI can write code for you to do a lot of things where you could build automated trading strategies off of these things. Um, Really not trivial to do, but also not really interesting thing that just happened right now. Look, we started to break out here to the upside, above this volume profile. So we've got a bell curve shape, but we started to break out here. This is interesting, and we'll have to take a look at this, right? We'll see, does volume kind of push higher here? It's right now up down volume is 1.6, so it's improving. It's not quite there yet. Usually want to see above 2.5, 3 is when we start to get a sense that, buyers have really started to step in here. Advanced decline has turned from negative to positive. Cumulative tick, we'll see if cumulative tick starts to improve. Maybe it gets to zero, maybe even gets positive here. But maybe this could be the start of a bit of a rally into the close. So this is kind of when you can start to see some of this stuff in real time. Yeah, so we'll see. This could just also be a false push and it comes right back. Right now, there doesn't seem to be enough information. There doesn't seem to be enough to say that buyers have started gaining control here, but we'll see if this starts to really improve here over the next 10, 15 minutes. Can you tell us what 0 days expiration strategies use bullish versus bearish signals given by OP? Oh, great question. So if you actually have a true bullish or bearish day, what you really want to do is buy slightly out of the money options, call options or put options, just a naked call or a naked put. That's it. Because if let's say you had bought a naked put, slightly out of the money at noon yesterday when you started to see things deteriorate, you would have hit a pretty nice home run by the end of the day. And when I talk about hitting home runs, we're talking about buying out of the money calls or puts, looking for that big move to hit some home runs. Are fair value and point of control closely related or the same? I've seen different platforms and different kind of publications call point of control different. I don't think, I don't recall ever seeing it being called fair value, but that doesn't mean that there aren't platforms that call it that. But almost every single platform that can plot volume profile will kind of have this like big fat bar or some kind of indication of like this is where the biggest profile or the most volume is traded. So TradingView uses this red bar. Other places will kind of make the biggest bar fatter or a different color. But it basically tells you like where the point of control is, meaning where is there most volume traded. No, you don't have to be an OptionsPlay subscriber to get access to the dashboard. You have to be a TradingView subscriber to get access to this dashboard. With that, that covers the questions that I see here for today. So just to show you, you kind of get this breakout here on the price chart, but the volume is not really there. The advanced decline's not really there yet. The cumulative tick is not there just yet. This is, at the moment, still more of, in my opinion, a bit of a false break at the moment. Not worthy of chasing just yet. Hopefully that kind of gives you a clear understanding of how to better gauge what's happening on an intraday basis to potentially hit some home runs in the next few weeks. Using these types of strategies. So just for example, if let's say we start to see this improve, right? Here's what I would do going into the close, right? If let's say we start to see, cumulative tick improve, we start to see up down volume kind of start getting into 2.5, 3, we start advanced decline getting into the 700 to $1,000 level. What would I do here, right? What I would do is I go to bullish. I turn this to a 0 days to expiration. When the stock's trading at 505, I'm probably looking at buying maybe a 506 or 507 call option. And basically, if this thing starts to rally into the 515, 520 range going into the close, you're going to get a really nice return on your 506 strike that you're paying about $2.50 on. So even if it gets up to like, let's say 515, your 506 option is now worth $9. You pay $250 for something that'll be worth $9 at the end of the day. So that's kind of how I would trade this if we start to see this improve. But at the moment, not enough evidence to show that. With that, thank you so much for your time and this week. We've demanded a lot of your time and attention this week, but I hope that what we've done this week is help you navigate through this volatility. It's not easy, it's scary, it's confusing. But that's why we decided to host sessions every single day this week to try to help you better understand how to navigate this market. And if you're subscribed to OptionsPlay, you're getting this type of notification. You've got the summary of kind of what's going on with the markets this morning. We're doing daily updates on the tariff and the trade wars to help give you a better understanding of how to think about this market, and doing sessions like this to give you more and more information and more tools that you need to navigate the extreme volatility that we expect will likely continue over the next few weeks. With that, thank you so much. I hope you guys have a great trading day, and I hope that for those of you that are have not signed up yet for a free trial, you decide to do so to get access to some of these tools. And if your free trial is expired, I hope that you consider signing up for your subscription to get access to everything as well. And I really want to thank all of our members for supporting us and allowing us to continue to do this. We are really incredibly grateful, and we're trying to do everything we can to support you through these relatively tough times. So thank you so much. I hope you guys have a great trading day, and I'll see you guys tomorrow afternoon on timing the markets. Really, really important session, in my opinion, to help you understand when you have lots of ideas, which ones do you actually trade from a timing perspective. So looking forward to hosting that session tomorrow. Thank you so much and have a great trading day.